Alright, so this is the next video lesson here in the titanium module, and this one is going to be on the T3 core butterfly trade. Now I think what I've decided to do, we'll see how long this first video ends up being. I may break this up into 2 or even 3 separate videos. That way I can keep them to 20, 30, 40 minutes in length and not feel like I am missing anything that's important to this type of setup. Alright, so right off the bat, this is a very similar trade and model after John's M3 trade, which is where I learned about it first from him and over time made it unique to myself. And so I want to give credit to John because, you know, the M3 trade is one of the most resilient, simplest trades to begin trading and becoming profitable with, but it does require some advanced knowledge about options and how you layer in deep in the money call options with balanced butterfly. I mean, there are a few moving parts to it, far and away more complicated than just a simple, you know, buying and selling an option. All right, there are several layers and legs to it. So I just want to make sure I address that up front and spend a few minutes really talking about the construct and the setup on it. Okay, so let's just go ahead and dig right in and talk about the setup. All right, so this is, you can utilize it specifically. You can experiment with the SPX or equities or other underlying assets. I have only traded this one in the RUT or the RUT IWM combo. Okay, so that's why I want to spend this time just talking about that. You can experiment with it on other vehicles, but just understand that the trades I will be showing, the testing we'll be doing, the mechanics of how this operates will be based upon the Russell 2000. All right, so that's the underlying asset we'll be using. Timing 60 days to expiration. Again, this right here I put on Mondays only. Some weeks it'll be 59 days to expiration. I used this in an example with a bunch of traders that I was teaching this to show and prove the point that it doesn't matter what the specific day you enter these trades on. That does not matter. What matters is how you manage it after the trade is loaded. And so you can absolutely open these at 65 days, 75 days, 50 days. They will all vary, they will all perform and react differently, but I like to put these on at about 60 days to expiration. I feel like sometimes the better fills happen on Mondays. Lately, I've been doing a lot more of my trading on Wednesdays. So again, you have to find what works best for you. So there's nothing magical about this 60-day to expiration mark, but we definitely want it to be longer than, you know, 10 or 15 or 20 days to expiration. Pushing this out a couple months into the future. And when the volatility is lower, we may even go out farther than that, 70, 75, 80, 85. I know some traders who are trading these at 100 plus days to expiration, and that's perfectly fine. Just understand, to gain the confidence in that, you're going to need to test it and trade it in those parameters. So step one is you buy a RUT put butterfly 50 points wide, the wings. Short strike is anywhere from 15 to 30 points under the current market. So let's just illustrate that real quick here. If we go out, let me go back here to, well, this one's gonna end up being a little under 60 days, so we'll go 59 days to expiration right here. We'll say we're gonna go 15 to 30 points under the market. If the Russell closes the day at 1410, we can go right here at 30 points under the market. We can say I'm going to sell 20, 1, 2, 3, 4, 5, buy 10, 1, 2, 3, 4, 5, buy 10. All right, so that is a 50-point wide wing butterfly. That's 50 points between the wing widths, balanced legs, short strike is 30 points under the market. Okay, so that is step one. Step two is you buy either an IWM or a Russell call option with delta greater than 80. This is an intentionally in the money call option. All right, so we'll just come right here at 80. We'll buy one, and so what you'll notice is this gives us too high of a delta positive number. So at the very beginning, what you'll need to experiment with is altering the contract size numbers to get your negative delta number at around 80. So in this particular setup, it might be this. All right. Oops, that needs to be minus 26. Yeah, so that's perfect. So I do not mind starting these out just a tad negative on the delta, and that's what they look like. All right. And what you'll learn through some of the trades and through testing and through some of the examples, I'd even go a little bit farther than that because I don't like this T+0 line dipping down underneath the 0 line on the x-axis as you get above that upper long wing. So in this particular case, I may even do 14. I may even do 15. Let's see what 14 looks like, however. And we may just go this. All right, 11. There we go. That's what I wanted to see. So we've got this T+0 line that's just hovering above the 0 line on the x-axis. And you'll notice that does make us a little bit delta positive. And you just have to find that balance of what reacts the best in your testing, and this is the initial way to get this set up. We can it does not matter that much between 11 or 12 or 13, but you know, if we put 10 or less than that, that would just change this too much. So step two is buying one of those with the delta greater than 80 so that you can keep that T+0 line as flat as possible but not dipping off too much on the upper side. All right, step three, take screenshots. I really want you to begin getting in that habit of taking the screenshots at inception of the price chart, of the risk profile graph. You can take of your execution and your fill prices if you'd like, but those are easy to go back in and capture, and begin building your doc files or PDF files, or you know, your trading plan that you can review after the trade is done, so that you can see when you started getting in trouble, what did the T+0 line do, what did your P&L look like, etc. So target profits, minimum 3 to 5% of margin deployed, realistic 5 to 10%, optimum is greater than 15. That's very unlikely when you're first starting out, but it is absolutely realistic and probable after you have been trading this for a while. Max loss 15%. Okay, so right off the bat, you'll see it starts out, if this starts out as a $20,000 trade using the Russell, do we calculate the margin or the maximum loss off of this margin? I do not, and I'll tell you the reason why I do not is because I'm planning on deploying more capital for a adjustment. Okay, so this may sit right here and never get any higher than this. So I would calculate my maximum loss off of this number. If I make adjustments and rolls and have to start maneuvering and doing stuff, well then my maximum loss number becomes calculated off of the maximum amount of margin that ever gets deployed in this trade. Additionally, the take profit values are also off the maximum margin of the trade, and you'll see that pretty clearly when we show some of the screenshots of the trades that I've taken and the trades that you'll have access to. So you have those parameters built in up front. Okay, initial upside adjustments. If when price trades greater than 20 points under the short strike, consider rolling butterfly down 20 points. No adjustment to the call at this time. Subsequent, and actually this should be, I'm going to change the wording on this just a little bit, just to make it clear. The second downside subsequent adjustment would be if it traded another 20 points under the short strike, roll back another 20 points, or consider closing it altogether, especially if it moves fast. And I'll show that in an example in 2011. I'll even do 2008 when the market was really unraveling and this trade performed perfectly fine. As far as the upside adjustments, when you get 10 points higher than the upper long, consider rolling it up. In low volatility, we're only going to move up the shorts, leave the longs alone. Secondary adjustment is when you get at the upper long strike a second time, consider rolling it up again, or just move the upper longs down when you enter profit protect mode. And that's when you get under 30 days to expiration. All right, so those are the adjustment guidelines and rule sets, if you will. T+0 line is what we're reinforcing and developing, in addition to the T1 and the T2, T7 variations, the weekly trades. That's what we're always talking about, the T+0 line, all right? Low vol environments must keep a little slightly negative delta to offset vol spike. No more two rolls down, especially in fast market, honor your max loss, and immediate exits if any of the three followings occur, okay? Now, we can absolutely trade this in an IRA. I do trade this in 2 IRAs personally, and they work very well. You don't get the power of the span margining like you do with some of the future options, but you can absolutely trade this in the most conservative fashion possible and do very well with it. Okay, so that's the actual setup. So the last thing I want to talk about just in this first one, and then I'll run through a quick little scenario, is if you're trading a smaller amount and you're not trading a $20,000 or $30,000 tranche size, well, this can be done with as little as $3,000. And OptionView does not have the capability to let me show you IWM and Russell together. So what we do to circumvent that and to get around that is we say, okay, well, we're gonna trade the same exact setup. We're gonna say, all right, I am going to put on, maybe I'll do 20 butterflies here, do the wing here, do the wing here. All right, and now I will come in here and I will say, well, let me do one call option. Gives me the same profile. Everything's exactly the same. And what you'll have to accept and realize in your mind is the IWM is 1/10 of the Russell, all right, of the Russell 2000. And if I show you that, you'll see right here is the IWM. We'll go to these options right here, expire in 60 days, and we'll say, let's change this to in the money large, and we'll go back and show you that the 1330 call strike on the Russell is the exact same as the 133 call strike on the IWM. All right, and if we look at the 133 call strike here on the IWM right here, all right, if I am going to, all right, here, there we go. All right, so delta is 81. It costs you $8.19. For me, what has worked well for me is I start looking above 80, but I also try and find these priced at about $10 or higher for that call option. All right, so but let's just write down 819 for the IWM call option, and we'll go back to Russell, and we'll see that that one is 89.27. All right, so you'll see that the price difference is very similar. It's in the range, but what you'll do is you'll say, all right, I am not trading the Russell IWM call because I'm only trading, you know, 1 or maybe even 2 of the Russell butterflies. All right, I'm trading 1 or even 2, so it's giving me a much lower margin requirement for the core butterfly, but then what I'm doing is I am layering a 133 IWM call option on top of that, and what that is going to do is that is going to cost me $8.19. All right, now this looks very odd because you've only got one butterfly and you're showing one in the money call, but understand that if this is what you're paying for that in the money IWM call, all right, then your maximum margin on this trade is 1856 at start. This is incorrect. Your risk profile will not look like this. Your risk profile will look like this. Your risk profile will, well, it's not going to be 819, so let's get rid of that. It's going to be 8927. Your risk profile will look like this with the IWM and Russell call. All right, and that will be a lot more clear when I show you some trade plans and some trades, and we'll walk through this setup in the Thinkorswim platform. But just understand that there are many variations and many ways that you can say, all right, I'm going to take a small amount of capital while I'm learning, and maybe for 6 months I'm going to trade this Russell IWM combo, 1 or 2 contracts only while I'm learning it, and then as I get skilled and more confident with that, I'll move that up to 4 or 5 contracts before I graduate to the Russell combo. That's going to be a lot more capital intensive, but it will react exactly the same way as the Russell IWM combo with a few added benefits and features. Okay, so that is the core setup construct of this, and I will have 1 or maybe 2 more videos down below that you'll be able to watch, just walking through example after example after example. So I think this will be a better format, so you can watch these in a shorter sitting at once instead of sitting down for a 3-hour long video of this nasty voice talking. So I hope that's all right. I hope you don't mind that, but yeah, this is going to be a great trade for you to add to your repertoire and your arsenal of options trading. All right, so thanks much, guys. Bye.